Good afternoon, everyone. Welcome to Sage Talking Business. Today, we're going to be doing an overall outlook on the economy and what are potentials as to how to manage a volatile market. One of the things that I find overall is that many times novice investors, they tend to pull out of the market when the market is volatile, and they tend to sit on the sidelines. Those who are expert in the market and well educated, they tend to take advantage of downturns and volatility in the market to be able to benefit when the market stabilizes and is continuously moving on the upside. What I'd like to do with my introduction is just kind of review some things that have happened in the past couple of weeks with regard to the Davos economic outlook for growth globally. But I'm going to focus on several things that's happening both in the US and in Africa as it pertains to debt, tariffs, and the economy overall. The first thing I want to do is bring up the IMF meeting that took place, or his commentary on the meeting. Guys, when you come on in, hit the like button, subscribe to the channel. Okay, so let me bring up the first video and we'll get into this as it pertains to 2023 GDP growth and forecast from the IMF. Put a 1 in the chat if you guys can hear me very well. One second, let me go ahead and share the screen. Bear with me 1 second. Okay, looks like everybody can hear me well. Absolutely, perfect. Okay, so I'm going to start with the IMF forecast for 2023 and their outlook. One of the things why I wanted to focus on doing a business show is because, you know, the black man per se may or may not be familiar with financial markets in a sophisticated way. And I think as you guys start to increase your income and make more money, you want to be able to make sure that you can preserve capital and find good opportunities where you can invest long term so you can profit. Understanding global markets and how they affect trade markets is very important. Storms, earthquakes, political situation, instability in different parts of the world can definitely affect what happens in the United States, what happens in the market, and how in certain cases you can benefit both on the downturn of a market situation and on the upturn of the market as well. So let me go ahead and bring this video up. I'll add it to the channel. And let's see. Let me blow it up. Well, first let me start it and then I can blow it up. Give me a hand here. Give me a moment. I'm still a little sloppy, but I'm getting there.
And the reasons why you have upgraded it, and possibly the opportunity to upgrade this forecast again soon.
Well, thank you for having me. What we are looking at is what effectively...
Drop a 1 in the chat to make sure you guys can hear everything clear, okay?
For 2023 is 2.9% growth, then rebounding to 3.1 in 2024. These are still relatively low growth numbers for the global economy, well below what we averaged from 2000 to 2019, for instance. But still, it's an upgrade compared to what we were expecting back in October. And this is due to resilience. We've had more resilient households in the US and businesses as well. We've had resilience to the energy crisis economies in Europe. A lot of economies have done better than was initially expected. Labor markets have been very, very tight in many emerging and advanced economies as well. And then in addition to all this, you have the reopening of the Chinese economy that is promising to give a boost to global activity in 2023.
Now, that resilience, Pierre-Olivier, is making the job of central bankers perversely harder here. What's your take?
Well, there is a little bit of good news on the inflation front, but we should not exaggerate it. So what we are seeing is that global inflation, headline inflation, has peaked already in 2022 and is coming down in the vast majority of countries. The worry is more with what we call core inflation, that excludes energy and food prices that are typically more volatile. And this core inflation measures have shown more persistent, and they have not peaked yet in many countries, and they are still far away from central bank targets. So the job is not done. And you are right to point out that more resilience on activity could mean more price pressures, could mean that it's harder for central banks to bring down inflation to target, and therefore they might need to do more.
I think that your boss, Kristalina Georgieva, has said, of course, the COVID, shall I say, the post-COVID zero China is going to perhaps be one of the impetuses for growth, as you've just alluded to. But it also could be the next sort of inflation headache as well.
Well, certainly as the Chinese economy reopens, that's going to put pressure on a number of primary commodities markets, energy markets, etc. But let's keep in mind that even with that China's reopening, we are upgrading China quite a bit. We are projecting 5.2% growth in 2023. That's a 0.8 percentage point upward revision for China for this year. Still, the global economy is slowing down. And in terms of the overall demand for energy and commodities, that is really what is going to be the driving force. So China is doing better, but the global economy is still cooling off. And in our projections, we are factoring in that we expect prices of energy and other commodities to actually decline through the year.
Growth in the economy, even though you're getting an echo. Okay, 1 second. Let me see if I can reduce that speaker output. Okay. Okay, as I continue, let me know if you're still hearing the echo, Rashad. Much appreciated. In any event, with regard to the overall outlook of the economy, general inflation seems to be tapering off. The problem is that the core inflation, which measures food and energy, which are usually the high price items that people tend to spend a lot of their income on, is still very strong. And that is where the concern is. There are some other things that I'm going to tap into to open up more opportunities so you guys can understand how, as from an investment standpoint, how you can use this type of instability to benefit yourself economically. This is a short video. It's only about 3 or 4 minutes. I'm not going to listen to the whole thing, but there is one part that I want to make sure that I cover. So just bear with me a second.
Now, you've also highlighted that the risks do remain to the downside. Why?
Well, I've mentioned already that we are far from having won the fight against inflation. There could be a lot more persistence in inflation. We've had a few good prints. It's encouraging. It's in the right direction. But let's not think that somehow the job is done. Far from it. There could be price pressures, there could be wage pressures, there could be an escalation of the war in Ukraine that again sends energy and commodity prices through the roof. So there are a number of factors that could complicate the outlook in 2023, and that would make potentially a recession more likely, a global recession more likely, may require more tightening by central bank. We could have also a tightening of financial conditions. So far, this has not happened too much, but this is a new environment. We have to be very vigilant in terms of the vulnerabilities in the financial markets, in the non-bank financial institutions, in the housing sector. This tightening of policy rates by central bank is something that is really changing the environment here, and we have to be very careful.
Okay. The key thing that he mentioned that needs to be addressed is energy, growth, and stall growth. China is projected to grow this year at about 5.2%. The United States will not be growing that strong. Most countries around the world is going to be growing around 2%. So there'll be lots of opportunities to find industries and companies in those sectors that are under pressure, where it has nothing to do with the management or overall performance of the company, other than just the fact that their outward forces, such as economic forces globally, that's affecting these companies to not grow as fast. What that will allow is for price to retrace, and with those opportunities, you'll be able to pick up good, solid blue chip stocks or solid technology stocks, or even some retail. And retail, you have to be real specific to be able to find investment opportunities there. The next company the next part of the conversation that I want to add is there's a big conversation right now with JP Morgan Chase. And JP Morgan Chase, as you guys may or may not know, carries a lot of weight as it pertains to their commentary on the market. So I want to go ahead and add that to the stream so we can have that conversation. JP Morgan. Okay. And the person that's being interviewed, she's the CEO of private client relationships, which is usually where the institutions are, and those are the people who make the big investments, right, in the economy.
Economy, U.S. economy, is it turning down? Is it not? Recession, not recession? I mean, something like people with.
I'm gonna start it over again, and then I'll blow it up.
So a lot of talk here about
clearly.
the economy, global economy, U.S. economy. Is it turning down? Is it not? Recession, not recession? I mean, something like people with $4.1 trillion have entrusted their hard-earned wealth to you to manage. How do you manage into a world where there may be a downturn, may even be a recession? How does it affect your decisions?
Yeah, it's a great question. First of all, I would say the tone here, having come here for the past decade, is less depressed than it often is, which is a good sign of hope of what's happening out there in the world. Having come off of the most difficult year for a balanced portfolio, 60-40, whether you were in stocks or bonds or anything in between, it was pretty rough sledding. And so I think everyone's happy that that's behind us and looking forward. And the job of what all of us at JP Morgan do is work on advising clients through the cycle. And so we're going to have lots of boom and bust cycles. You've had a few people on today talking about it. And I think the most important thing is to stay focused on diversification, opportunity, not getting wedded to any one thing that looks like it worked in the past. It may not work in the future. And so we're spending a lot of time on that. I mean, one of the things that really manifested itself through COVID was the problem of home country bias, which creeps into almost.
Let me know if you guys are still picking up an echo. If you are, I'm going to put on my headset to eliminate that. I don't want you guys not to be able to hear what's going on. So are you still hearing an echo? Drop me a 2 if you guys are still hearing an echo. If you're not, then I'll continue. Sounds good? Okay. All right, cool. But when I'm playing the video, can you guys hear it clearly, or are you having some kind of feedback when I'm playing the video? Okay, I'll go ahead and continue. Just if you're hearing an echo, just drop a 2. Anyone in the chat?
Of diversifying out of it. So not only home country bias in terms of the stocks and the bonds you buy, but also the currency. And I think it's now a really important time that people think about how to get all of that, the opportunities that they may have missed in other parts of the world, especially parts of the world that are, reopening and making it very interesting.
How about that, China? We have had the development today of Liu He, the vice premier, meeting with Janet Yellen, not too far from here in Zurich, to try to start talking again. What do you project for your investment purposes about what is likely to go on with China, and how hopeful are you that that reopening could really stimulate the world economy?
Yeah, absolutely. Having come back from Hong Kong just a few weeks ago, you can just see the pent-up demand of what's there. People wanting to go in country, people wanting to come out of country to travel around the world. I think the opening up of China, while it will have its ups and downs, it will hopefully be a net exporter of deflation, which would be good for the world, getting all of those kinks out of the system and really bringing back growth in a positive way. So I'm looking forward to that. I just say, for us at JP Morgan, getting to see our people who are on the ground in China and have been working so hard throughout these many years of us not being able to travel in, we're really excited about that. We're looking forward to lots of good reunions and the like, but people are really excited. And I think it means a lot of things. The tone that you're hearing.
Okay, so what she's talking about primarily when she says getting their people on the ground, they need to get into the factories. They need to see how production look, as opposed to just estimates that the companies in China may be giving them in writing. With the CV that's been going on for the past 2 years plus now, we know China has been shut down for 2 years overall. They have recently reopened the country, fully reopened, and obviously we know that there's been a spike in infections, but they're managing that situation. In any event, similar to what took place last year with us in the United States, when they finally opened up the country fully and dropped all of the various mandates, business started to pick up. And I think this is the same thing that we'll be able to see as China begins to grow to fulfill its responsibilities with regard to the global market. The next video I want to bring up is really BlackRock, which is one of the major companies worldwide. The CEO had a very insightful commentary. It's just a short clip, but I want to bring that in because it adds some real value as to how the bigger companies who are forward-looking in terms of the global economy, what they see coming ahead. Let me add this to the stream. Okay, give me a second. Okay. Now, as I said, this is just a clip. It's going to be a very short message that he has to deliver, but I think it's very vital.
Inflation, as much I worry about, is anemic growth for the next 5 to 7 years. I don't know how we're going to get out of this 2% growth rate. And that's my bigger issue. We're not going to have the fiscal abilities unless we grow to add on more fiscal stimulus. And we're certainly not going to have accommodative central bank behavior for the next few years.
Okay, I'm going to replay that because I'm not sure if you guys got an ability to hear all that he said.
Anemic growth for the next 5 to 7 years. I don't know how we're going to get out of this 2% growth rate. And that's my bigger issue. We're not going to have the fiscal abilities unless we grow to add on more fiscal stimulus. And we're certainly not going to have accommodative central bank behavior for the next few years.
Okay, so basically what he's pointing out, which is,
I worry about.
Let me just take this down. It's playing in a loop. Okay. Basically, his core concern has to do with slow growth because the United States, Europe, the UK, Canada, they're more than likely going to have to use some method to stimulate the economy. But doing that, if they have to write more debt, print more dollars without growth, is going to be a real big problem. So what he was citing is anemic growth. Anemic growth obviously mean a growth that's going to be around 1% to 2%. For growth to really be to show profitability in the United States and Europe, you need to show growth north of 4%. China is at 5.2. The projection is that it will drop to 4 in 2024. We'll see. That could change during the course of this year as well. I want to switch now to what's going on the continent, Africa, because there's several things going on in Africa with regard to its debt. And this is going to weigh very heavily on how Africa actually, if they're able to really become a strong country economically overall. So first, I'm going to run a quick video from Morning Business dealing with the overall analysis of the outlook for Africa and particularly Nigeria and the debt Nigeria is carrying. Give me 1 second. Let me add it to the screen. Okay. Let me know if you guys can see it. Can you guys see it in the chat before I start the video? Drop a 1 real quick. Okay. Now, one of the things is that
obviously
some of these conversations and discussions are very sophisticated because of the professionals that are speaking, but I'll try and break it down simpler for those of you who may have a question on something. Just drop your question in the chat and I'll go ahead and respond to it. Let's continue.
An issue globally. According to the Debt Management Office, public debt rose to 44.06 trillion in the third quarter of 2022, and the total debt stock rose from 42.84 trillion recorded in the second quarter to 44.06 trillion in the third quarter 2022. Let's get an outlook of Nigeria's debt profile. In 2023, join us now is Kelvin Emmanuel, CEO Derry Hills, join us from Abuja. Great to have you. Happy New Year.
Good morning, laddie.
Good morning.
Happy New Year to you.
Yeah, it's all about debt at this point. It reminds me of that book where they talked about the kiss of debt. Looks like it's becoming a global issue right now.
Okay, before I continue, I want to go back to that screenshot that showed
obviously with
the amount of debt
Laddie,
Good morning.
Happy New Year.
that Nigeria is carrying, which is even higher.
Emmanuel, CEO Derry Hills, join us from Abuja. Great to have you. Happy New Year.
Good morning, laddie.
Good morning.
I'm sorry.
2022.
Okay,
Let's,
this
get an
screen
outlook.
right here. I want you guys to take a look at this because this is very important as it pertains to the financial stability of a country. If you're looking at Nigeria's debt, in 1999, their debt external, including all creditors that invest in the country from outside of the country, was 28 billion. Internal was 795 billion. By 2015, that was up to, well, actually they dropped the external debt and they dropped the internal debt. But most recently, with the new leadership that has been ruling the country, the debt situation has spiraled out of control. And they're going to get into breaking that down and how the instability financially of Nigeria that some forecasts are calling for potentially a collapse of Nigeria's economy if they're not able to get this debt situation under control. Because right now they're only paying the servicing on the debt. They're not even hitting the principal on the debt. But let's continue.
Of Nigeria's debt profile. In 2023, join us now is Kelvin Emmanuel, CEO Derry Hills. Join us from Abuja. Great to have you. Happy New Year.
Good morning, Laddie.
Good morning.
Happy New Year to you.
Yeah, it's all about debt at this point. It reminds me of that book where they talked about the kiss of debt. It looks like it's becoming a global issue right now, obviously with tightening rates at this time. But the WEF does not see debt as the main issue for Nigeria in 2023. Talking about the risk, I did read that report earlier. How you seen it?
Laddie, please, can you just backtrack on the question? I didn't get.
Okay, so yeah, I did read the report, by the WEF. They said the major risk for Nigeria is the cost of living crisis, but debt is also a risk, but it's not the major risk. So how are you seeing the whole debt issue with Nigeria?
Well, cost of living, the debt has there's implication. You can draw correlations between cost of living, cost price index, inflation, and the debt situation in Nigeria. If you look at the fact that the government has accumulated about 24 trillion naira in ways and means lending, which started in 2007, by the way, and you consider the fact that that has had an impact on currency devaluation in Nigeria and the acceleration of inflation in 2022, for 10 consecutive months, the central bank noticed that the inflation kept rising consecutively for 10 months. And in several meetings, it raised the MPR by 500 basis points. So there's a strong correlation between inflation, cost of living, the fact that the purchasing power parity of Nigerians has reduced by about 47% over the last 8 years since President Buhari took office, and that's the per capita income, the Human Development Index, and the debt situation in Nigeria. And speaking about the debt profile Nigeria has, it's quite unfortunate because if you consider the numbers, if you go back in time to 1999, Laddie, you notice that Nigeria had a
This up. Sorry about that. Had a call real quick just now. Thank you. Yes, the main thing that he's addressing is the cost of living per capita for each Nigerian to be able to buy staples. And when it pertains to staples, staples has to do with your daily, what you need to eat and what you need to keep your life going. Lights, energy, gasoline. So as it pertains to gasoline for transportation and as it pertains to food, that's becoming a real big issue for Nigeria or the Nigerians. So the debt, and he was getting ready to break down the debt from 1999. I showed you guys that chart, but what I want to get to is the debt as go. I'm going to skip ahead. Let's see. Bear with me 1 second.
Nigerian today owe debt per capita 368,000 naira plus to creditors, both local and international.
Okay, that number that he quoted just now, 368,000 Nigerians. What's that? Naira or Naira is the name of the currency. Each Nigerian, if they were to actually spread out the cost on what it would cost each Nigerian to be able to pay that debt back, it's over 368,000 Nigerians currency. And that's currently right now with the national debt at 77 trillion of their dollars. That's not US dollars. That is the Nigerian Naira, right? So many risk management rating companies such as Moody's, such as Fitch rating company, and S&P, they're currently looking at Nigeria as a downgrade. They have now fell from out of investment grade to non-investment grade, which would be high risk, which will slow the ability for foreign investors to come in and do development within the country as well. The oil sector, obviously, that's still strong for the country. But overall, the management, the leadership of the country with regard to the debt is a real big issue. And 368,000 Naira per citizen is beyond the country's ability to be able to maintain. And what they're servicing right now on the debt is really not even the physical debt itself, just the interest. So creditors are getting concerned, which are the bondholders.
National.
All right, but Kelvin, tell me about because some analysts have said it's not about the the size of the debt, that it's the pace, the pace of growth of the debt. How are we doing? Looking at the pace so far.
The pace is frightening. If some people are saying that it's not about the size, it's the pace is very frightening, because you can imagine President Obasanjo looking at what he left in 2007 at 2.4 trillion, that has risen to 77 trillion naira today. And you can imagine that 29% of your budget is going into servicing debt for 2023. So basically, somewhere around 48% of Nigeria's budget for 2023 is going to go into two line items: debt servicing and PMS subsidy. And that PMS subsidy of about 30.6 trillion is only for 6 months. If the next president decides to remove
Okay, sorry about that. I was muted. Yes, what I was saying is that 48% of the GDP for Nigeria currently is being used to pay off the debt, or service the debt. I shouldn't say pay off the debt, service the debt. So they're only really paying on two aspects. They're paying on the interest, and they're paying on something that's called PPI? Let me just 40% Nigeria. PMS, the PMS services, which is a government subsidy that the government provides. So the servicing on the debt service, which is the interest rates that they're paying on the bonds, and the PMS service for overall, I guess, to help try to stimulate the country with regard to different products that they may subsidize to keep costs low. This is going to be a real issue, and particularly as it pertains to the politics of the country, because the new president potentially could come in this year and turn all of that upside down and just cancel this recent agreement that was reached. Let me go back to the video so you guys can hear his complete explanation. I'm going to back it up a little bit so we can catch the beginning of that commentary.
Debt servicing and PMS subsidy. And that PMS subsidy of about 30.6 trillion is only for 6 months. If the next president decides to remove PMS under recovery on PMS, direct sales, direct purchase, within the first 2 months or 3 months of him being the president, then he doesn't need to provide another 30 trillion naira for PMS subsidy. But 2 line items alone takes 48%. And those 2 line items, has nothing to do with growing the economy. It's just to service debt and to make sure that PMS in Nigeria is cheap, which in my opinion, the daily consumption volumes are seriously inflated. So I disagree that the pace is not as frantic and fast and does not call for concern. It calls for grave concern because at the level we are today, your debt to GDP ratio is going to rise to 35% of GDP. Debt is going to rise to 35% of GDP by the 3rd quarter of 2023. And that calls for serious concern. Because when you look at and this is why I like
this is where many risk management and rating houses such as Moody's or S&P or Fitch, why they have downgraded Nigeria, because potentially what this analyst is talking about is probably within the next 6 months, you can see 85% of the GDP, which is the gross national product of the country, meaning everything that they make and sell, and the revenues that they get from that. The total revenues of the country could potentially, 85% of it could be going towards managing this debt situation. Currently, they're at 48%, but that could almost double by summer. And that's why so many financial analysts are looking at potentially that Nigeria can actually collapse economically. Not similar to what happened in Pakistan, but it could have a very serious effect if either the IMF or any of the major financial world organizations don't step in to try to help them with regard to restructuring their debt situation. So this is major. Let's continue.
I like, let the government, let the officials in government, let them refer back to the law. What does the law say? Because I've heard people say, they're going to decouple debts from revenue and expenditure. What does the law say? Are you breaking the law in going around and borrowing on a borrowing spree? Yes, the government is breaking the law. Because if you look at the Fiscal Responsibility Act of 2007, sections 41, subsections 1A, it says that the Nigerian government can only borrow money to fund capital expenditure and human development. But what are we doing today? We're borrowing money to pay PMS subsidy, and we're borrowing money to pay interest on existing debt, consolidated debt. So it is a cause of concern, and it's very worrying and disturbing.
Right, and obviously, Kelvin, Sub-Saharan Africa seems to be going through, some kind of debt servicing, shock at this time. I've seen a report, forecasting for 2026 that, the whole of Sub-Saharan Africa is having a debt, issue at this time. But how are we doing compared to our African peers?
The reason why, Ladi, I don't believe we're doing well is because our tax to revenue ratio is 6.3 to 6.4%. Our both tax and non-tax revenue to GDP ratio is somewhere between 7.2 and 7.4%. That is very low. Even Ghana, that is in a debt crisis and that had a default on its debts, has a revenue to GDP ratio of 14%. South Africa has a revenue to GDP ratio of 22%. Egypt has a revenue to GDP ratio of 18%. Last year, South Africa raised about $122 billion in revenue. How much did Nigeria raise? Egypt raised about $82 billion in revenue. How much did Nigeria raise? So these are the questions we should ask. if we're saying that, oh, we're not doing badly compared to our sub-Saharan African peers, the question we should ask ourselves is, what is our revenue to GDP ratio? And the solution is not by raising tax arbitrarily. Like, for example, the amendment to the Finance Act that was proposed that has generated a lot of protest on a single non...
Okay, what he's talking about here is very critical because two things he's trying to address. One, the legality of how the government is raising money and how they're spending money. The debt or the revenue of the country as it pertains to the GDP in terms of new money that they can raise is essential. And if they're not able to use the money that they raise specifically for growth, this is where there's serious concerns. And he's basically citing they need to go back to the law as it pertains to how the country fiscally manages the money that it raises through either independent financing through bond sales or through their exports and production for the entire GDP of the country. So those are the issues that are very vital to the growth of not only Nigeria, but mostly part of Southern Africa is included. Kenya is doing a reconstructuring right now with regard to their economy, and Zambia is also in the process or in the midst of doing a reorganization. I'm going to cut this video loose because it goes up to about 15 minutes, but we don't need to go through all of that. But I do want to bring up the Zambia interview because I think that is very vital. Let me bring that up 1 second. So Zambia debt reconstruction. Or restructuring. This is a short 4-minute video, so we can go through it real quick.
Touring Africa, we told you about how she was in South Africa yesterday. Earlier in the week, she was in Zambia and made some observations, noting that it was critically important to restructure its debt. And she believes that progress could be made after her friend talks with, after their friend talked with China, which they owe about $6 billion. Now let's have Matt Kiniger joining us now to help us see some of the implications of this restructuring. Matt, good afternoon. So tell us, what are the prospects of a successful debt structuring when we look at the situation in Zambia?
Hi, thanks for having me on the show today. So I would say the prospects for a debt restructuring imminently, so over the next 6 months or even the next year, are probably not very strong. The issue is that debt talks are being held up by Chinese demands to include foreigners who hold local currency bonds into the restructuring process. And at the moment, it's very unclear how long this process will last in terms of the negotiations. A resolution to this issue is not particularly likely to come in the first half of 2023, as negotiations so far seem to be quite rigid, actually, so not very much movement there. If the country does exit default, and if there is a sort of meaningful restructuring of its debt this year, it'll really be in the second half of this year. But again, there's no clear timeline, and in our view, it's actually much more likely to occur in 2024. So we're not really holding our breath at the moment. We don't think it's very imminent.
Well, not sounding good. But how does this issue of default and all of that affect their outlook for the year?
Yeah, so I mean, it does sound quite unlikely that Zambia's exit from default will happen this year. Having said that, the economy is still growing, and some sectors of the economy are doing relatively well. So we're forecasting growth of about 3% in 2023, which is not too bad considering the country is blocked out of international capital markets. There are a couple of things that will be driving growth. We are seeing quite strong investment into the mining industry. We've seen Canadian mining companies invest there. We're also, copper prices are very high at the moment. This is a very strong boost for exports and government revenues to an extent. Having said that, the country is facing quite severe power shortages at the moment, so that is affecting industrial productivity. And also, obviously, the default and the continued state of sovereign default does mean that public finances are very constrained. So government investment, government spending will also be very muted. The government will have very limited ability to kickstart the economy through spending and investment. So it will contain growth over the next year or so. But overall,
let me just kind of capture real quick what he's talking about. What he's saying, because he was saying a lot of stuff real fast. What he's saying basically is that Zambia doesn't have the ability to get its debt restructured because they're limited to how they can raise money. So they can't go to the IMF and different organizations to try to raise money that way. So they're having a real difficult problem. The good news is that they're forecasting about a 3% growth. For the country to be strong, they would have to be at about 4% growth. However, they do have a strong mineral or mining market, and that's potentially where you're going to see the growth happen from an investment standpoint. And I'll get into that later as I go through the other parts of what's going on with the United States, Mexico, and Canada, and how those things that's going on now can affect pricing overall and can also create investment opportunities for individuals who have the money to take advantage of markets under pressure, right? So let me continue the video. It only got about a minute and a half left.
Considering how the country remains in default, we are still expecting it to grow, so not doing too badly.
I wonder how the kwacha will also look like.
Yeah, so it's a good question to ask because the kwacha has been through a bit of a difficult time recently, especially since the sort of end of Q3 last year. It's lost quite a lot of value against the dollar. This depreciation, in our view, likely signals investors' continued pessimism regarding the prospect of the country exiting its debt default, and it's all related to this difficulty in restructuring its debts. Our view is that the longer the country remains in default, the longer the kwacha will remain under pressure. Maybe we'll see some more depreciation. Our view is that the kwacha will remain quite volatile in 2023, and we are going to see it likely exceed 20 per dollar for the foreseeable future. There are other drivers as well. We are seeing generally a strong dollar, which is affecting all emerging market currencies, and this is being driven by quite a significant US Federal Reserve tightening. So really what we would need to see is a substantial set of progress made towards debt renegotiations and an exit from default before the kwacha stabilizes over the next year or so.
All right, Matt.
Okay, so basically, let me just take this down. Basically, what he's talking about is how will Zambia go forward? They're trying to restructure their debt, and basically they defaulted on their payments. Very similar to what was happening in the US just a few weeks ago, right? They had to raise the debt ceiling for the United States so it doesn't default on any of its payments to investors and creditors. That's what happened with Gambia. So when you default, it's very much like if you have your own, you make $5,000 a month, but your expenses are $6,500 a month. You can only use credit cards, borrow money up to a certain amount. After that, you're going to miss a payment on something or a couple of things. Once you start missing payments, that's when your credit cards are going to start getting shut down and different things like that. So basically, that's what happened with Gambia. They defaulted on some payments, and because of that, they're now locked out of credit markets. So they are looking to have to try to restructure their overall debt to put them in a position where they can show profitability as a country going forward. Now, there's something really major going on near home, right? Which is Mexico and the United States. Currently, right now, Mexico has raised its tariffs on corn. And corn is a very big staple worldwide as to how it is consumed and used for many things. And the United States is a very big global producer and exporter of corn. So that definitely will affect how the U.S. producers, in terms of profit, how they will be able to make money, because Mexico is a big market that they export to. And if Mexico have a 50% tariff, that means they have to pay big, which cuts into their profits. So I'm gonna excuse me, I'm gonna add this other video. So this is a brief introduction about the U.S. market with corn, and then I'm gonna go into the more recent announcement by Chipotle and senators who are trying to pressure Mexico into following the NASDAQ, the NAFTA agreement, I should say, the NAFTA agreement between both Mexico and the United States, and Canada and the United States. So that's where they have a big problem in that market as well. Let's see here. Add to screen. Let me know if you guys can see clearly. Okay, let me bring that up. Okay, cool.
Has just about 90 million acres of this viral kid's absolute favorite food.
Cone.
What do you like about corn? It's corn. There's a reason people call it yellow gold. 2021's corn crop was worth over $86 billion.
According to the USDA, the U.S. is the largest consumer, producer, and exporter of corn in the world.
I mean, look at this chart of U.S. grain crops. And that's because
we're really good at it. And that's why you see big acres, big demand, export competitiveness. We're good at it.
It's not just what we eat, it's in what we buy and how we fuel up.
We've kind of turbocharged the value of corn through the application of science.
Corn is just getting more and more useful, which is causing not just the US economy to rely on this grain, but also the rest of the world. At $2.2 billion in 2019, corn is the most heavily subsidized of all.
Do we get the corn acres because we've got the support, or do we have the support because we have the corn acres?
Here's how the United States became a corn powerhouse. There's sweet corn at barbecues or even your popcorn.
And then there's this corn. This corn is the majority of what's grown in the U.S.
Field corn is 99% of what you see when you drive down the road. The other 1% is sweet corn or edible corn. Corn is certainly used in many, many more ways than it was, say, in the 1950s and 60s.
A lot of the corn that's grown in the U.S. and traditionally was grown in the U.S. to be fed to livestock.
Animal feed accounts for about 40% of total domestic corn use. So even if you're not eating corn directly, it's being fed to the meat that Americans consume. Corn is milled by either a wet or dry process. So it's transformed into syrups and starches that also end up as ingredients in other processed foods people eat every day. Think high fructose corn syrup. corn oil, cereal, corn flour, corn grits, corn meal, and much more.
A lot of corn is now going into biofuel production, specifically ethanol.
Just about every gallon of gasoline in the US contains up to 10% ethanol. Doing the math,
I was speaking a few seconds ago and I was muted. I apologize for that. What she was saying, or what I was leading into, is the vital use of corn. White corn is used for consumption, and number two corn, yellow corn overall, is used for feed, while livestock, whether it's sheep, whether it's pigs, whether it's cows, you name it. Most animal feed is produced by corn, or corn makes up a good significant amount of it. In addition, overall, as it pertains to gasoline, petrol, about 10%, maybe 15% of it is utilized in all production of gasoline. So corn is a very vital and stable part of the economy for the United States in general, because the United States is one of the largest, if not the largest, exporters of corn. Let's continue. Give me 1 second here. Okay.
in 2019, ethanol contributed more than $43 billion to the US GDP, and it added $23.3 billion to household income. All of this created over $10 billion in tax revenue that year.
These demands have kind of grown along with our really productive corn crops in the United States.
The U.S. wasn't always a corn superpower, which it is. We have the soils and climate on a wide scale, particularly in the U.S. Midwest.
A lot of this corn is grown here, which is why it's called the Corn Belt.
So I'm Seth Meyer. I'm USDA's chief economist. I'm an Iowan, if that helps with my authority on corn. U.S. producers just continue to show an upward trend of how many bushels they can get per acre.
There was a revolution in corn production after World War II.
As a weapon for our defense.
We can thank science and the private sector's plant breeding and genetics investments.
Filled with corn.
The overall number of farms growing feed grains like corn is declining, but the acreage dedicated to growing corn on those farms is growing.
At the same time, the amount of large corn farms has increased over time, outnumbering the amount of small corn farms in operation.
This is all to say that corn is big business, really big business, thanks to advances in seeds, fertilizers, and production practices.
These charts show how much corn crops in the US are now producing. So even with more land dedicated to corn, the plant itself is yielding more of a harvest. And these
This is what I wanted to touch on as we go forward, as it pertains to the things I want to be able to focus on as I develop this platform. Finding niche markets that are outperforming the overall market and showing growth for opportunities to invest. Because the United States produce so much corn and export so much corn, it is vital that that gateway between Canada and Mexico, it maintains itself. Recently, and I'm going to drop this down for a minute, and I'm going to, well, let me see, maybe I can drop this for a minute and add this major news event that just came out a few weeks ago. Let me see. Chipotle. U.S. Senator. Bear with me 1 second, guys. I thought I had the article already up. I thought I had Market Watch. Give me 1 second here. Let's see. All right, this is Mexico's daily news on tariff. Let's see, add to stream. This is the big deal that's going on with corn right now. Mexico places a temporary 50% tariff on white corn. White corn is consumer corn, the corn that you eat for barbecues and so forth, or that you buy in a can and you boil it down and you serve it with your meals. And in Latin America, corn represents a big part of the staple for foods and what's eaten. One of the biggest stores in the United States, Chipotle, they use obviously a lot of corn. 50%, a 50% increase on tariff for corn to the placed on the United States by Mexico means that farmers, producers, those who sell will have a significant loss in overall revenues. Says the rising cost of white corn is one factor pushing the price of tortilla, a key source of calories to many Mexicans. The Mexican government has announced a temporary 50% levy on exports of white corn in an attempt to control the rising prices of staple commodities. The decree published in Mexico's official Federal Gazette on Monday will remain in effect until June 30th, 2023. And let me just jump down to the bottom. I'm not going to read this whole article, but at the bottom, it really gave some very good insights to kind of surmise. Let's see, can you guys see the article? Okay, let me blow this up so you guys can see it. Okay, with it blown up, I can't manage the screen that well when it's blown up, and I need to be able to read this to you guys so you can understand it real quick. So I'm just going to switch back to a middle screen. In any event, it says right now, let's see, according to the data from Mexico's national statistics, the average price of tortilla in Mexico showed a 19% annual increase at the close of 2022. That's big. That's 19% is almost 20%. That means out of every dollar, 20 cents goes towards their spending on tortilla. So that's a major effect on the overall economy of Mexico. The decree notes that white corn makes up to 89% of Mexico's grain production, which is what they export, with 333 kilograms per capita consumed annually in the country. Much of this is in the form of tortillas. Why is this important? This is important simply because we're getting ready to come into a major season here in the United States, and that's called, which I didn't know existed, but it does, the burrito season. And we're going to talk about that for one quick second, right? Let me see if I can add that to the screen, because that's a major announcement. And obviously, it's going to have a twofold effect on the bottom line for this company. Okay, so Chipotle to hire 15,000 employees. to beef up staff for burrito season. I wasn't aware that there's such a thing as a burrito season, but nonetheless, this is a major hire for this company, especially right now, since everything else in the economy is either stagnated or muted. When I say muted, I mean stagnated. It's not really moving. The economy overall, in terms of various sectors, are just stagnant. This is a major hire for this company. However, the major problem will lie with the costs in terms of buying corn. So that's going to eat into the revenues of Chipotle potentially. Let me see if I can show you guys what's going on market-wise for Chipotle. The symbol for Chipotle is CMG. If you're looking to invest in a company like that, you would probably have to buy options simply because the price is just way too high. They're trading over $1,600 per share, which is, normally when you buy stocks, you need to purchase 100 shares as a minimum, right? So that's definitely going to affect the overall market. You could see Chipotle in the next, I would say, first quarter will be the end of March, going into April when they report numbers. We're going to have to see what their numbers look like, if they give forward guidance of still being able to maintain revenues, or are they going to be hit between January and March for the first quarter, and what the outlook will look like overall. However, if the company is hit, when it goes down, it's going to really create an opportunity to go in and buy, whether you're going to buy options or for those who can actually buy the stock itself. The overall problem that I see as it pertains to investment as you go forward, there are two main sectors that I think will present investors with opportunity. One would be the food sector, and in this case, corn would be something to look at because it's going to be under pressure. And energy. Energy could be oil, natural gas, anything as it pertains to energy right now. You can see prices continue to inch up because the winter wasn't as bad as expected. Europe did not have a bad winter, so natural liquid gas did not have a big issue with them because of the cutoff with the Nord Stream pipeline with Russia. However, in the summer, people also consume a lot of energy. People drive everywhere, and people are using the air condition. So my outlook right now is to look at specifically consumer foods and energy as a potential sector of the market for potential investment. And on following shows, I'm going to go more into detail. Today's show is really just to take a broad overview of what the market looks like, what growth looked like from the World Economic Conference in Davos a couple of weeks ago, what they're projecting with regard to U.S. growth, China's growth, Africa's growth, and debt restructuring for certain major economies. Today, they had also the Fed's meeting with regard to raising interest rates to stem inflation. I didn't get everything on that. I was looking at it earlier. Let me drop the screen down, stop sharing so I can. I didn't get all of the news with regard to what the final is on the Fed outlook. I was listening to it in the background. However, they do see inflation or top line inflation coming down, but the core inflation, which includes energy and food, that is still high. So that's something they will have to work on to be able to try to bring that core inflation down, which is energy costs and food costs. Because if they can't bring that down, more than likely, you would probably see another stimulus probably coming early into the summer, that the government will probably do something like that in general. That is good for overall for the economy and for everybody that's spending, but it's going to be bad on the back end because that means they're adding more debt that has to be serviced. Tomorrow, I want to talk about how you can use debt as an investment tool, right? Because something I think that many of us are not familiar with, we only look at maybe Bitcoins and possibly stocks. But the debt market is a huge market, and the debt market is another way on how you can really make money. And the debt market is a bond market overall. So for today's show, this is what I want to talk about today: the overall economy, Davos, their outlook, Africa, and China, primarily with opportunities in emerging markets as well. Emerging markets would be China, would be India, would be Africa. Tomorrow we'll have another show tomorrow. I don't have a set time yet. I'll speak with HR, with JR, and post the time early enough where you guys can tap in and be aware of the show. Thank you very much for tuning in to Sage Talk today. Every day as we go by, I'm going to look to improve the show as I get better at doing this on my own. Let me just shout out the super chat that came in early at the beginning of the show. Chris M., thank you for the super chat, $50 for your support. Thank you, my brother. I look forward to seeing you. And what I'm going to do is make sure I add you as to become a mod for the next show. Okay, thank you very much. This is Sage Talking Business, signing out.